joining us now. We've got Chris Versace, Chief Investment Officer, Chamatica Research, and Portfolio Manager of the Street Pro Portfolio. All right, Chris. So right before we're on, you asked me the question on what I think is going to happen today. Now I get to ask you the question on what you think is going to happen today with the Fed. So what do you think? What do you expect?
So everybody expects 25 basis points. No real surprise there. You know, very small percentage of 50. I think after some of the numbers we've gotten the last couple days, retail sales, Atlanta Fed GDP now getting bumped up to 3.4% for the current quarter. I don't think that's going to happen. So we'll go with 25 basis points. But the big question is how many rate cuts will the Fed telegraph in the updated set of economic projections, 2025 and 2026. I say this because our friend, the CME FedWatch tool, says 6 cuts, and I don't think we're going to get that.
I can't see the path for that.
No, why would they?
But let me ask you this. How surprised would you be? And look, I know we haven't seen any telegraphs, so sometimes that happens, if there was a jumbo cut today.
I think that would, I think the market would react positively, but I think then the question is, what's the language from Powell about that, about the prospects for future rate cuts? Does he say this is kind of a one and done catch up here? Now we need to see what the incoming data is, which I suspect he's going to say anyway.
Yeah.
My suspicion is that we get 2 rate cuts in 2025. They telegraph 2 in 2026, which is 1 more than what they said in June. And the language is data dependent, subject to incoming data.
That's what I think too. I mean, not that my opinion matters on this.
Of course it does.
That's kind of you. All right, let's talk a little bit about the other, side of their mandate. Lately, we've all been talking a lot about the job side, and there was more focus on that at Jackson Hole. Inflation, the Fed chair, Jay Powell, has talked about expecting it to be. He didn't use the word transitory this time around, but yes, I know. But what are you seeing as it relates to companies and how they're baking in the effects?
So if we take a look at the ISM data, which we kind of use as a leading indicator, those numbers, especially on the services side, have been elevated for the last several months. And we're hearing companies saying, okay, now we're starting to restock at higher prices. We will need to push higher prices through. And we heard some of this from Walmart and other retailers. So I think the inflation pressure is likely to remain elevated. And I think the Fed understands this, they hear this. And I think this is why they're going to proceed cautiously.
Okay.
Again, data dependent. And the market might expect 6 rate cuts in 2026, 2025 and 2026, but there's no reason for the Fed to go big.
What's your temperature check on the state of the economy now? Because we've seen, some good things, retail sales still holding up, right? So the consumer is still holding up to some degree.
So far.
Even still going out. I mean, food and beverage had some gains there, so I was actually surprised to see that. Okay, I missed that one. Good catch there.
So I think we need to be careful, right? Because these rolling GDP forecasts, they are just that, they're rolling, and we still have, a little more August data to get and a whole month of September. And, we can talk about 3.4%. That could be revised lower. The New York Fed is 2.1 this quarter, 2.2. I think that's probably a little more in line with reality. But even at that level, the Fed doesn't necessarily need to stimulate the economy. So I think the question is, we can give you a rate cut. Why do we need to do so much? I think that's the big question.
And then let me ask you this: do you expect? So if we got this a surprise jumbo cut, you could see it being off to the races. Do you think we have a sell the news event today with 25 basis points baked in?
I think if they deliver 25 basis points, they reiterate 2 cuts this year, and they just bump up the number of cuts from next year from 1 to call it 2, maybe even 3, way less than the market is thinking. Then you sit back, you look at the market valuation, you look at where the VIX is, and you look at the run up in the market. More importantly, I think that's the case. All
right, let's talk about a few names that you have on your watch list. Marvell, it's been an underperformer year to date. Why do you like it now?
Well, have liked it, for a couple different reasons. A, they benefit from the AI, data center ramp. Not exactly new news. They also benefit from the ramping business, Meta, Amazon, Google, and they should have a strong ramp in the December quarter.
Okay.
And then finally, as all this AI adoption happens, we are going to see existing networks get bottlenecked. That's going to be very good for incremental capacity for enterprise networking and carrier infrastructure.
Okay, you got a couple other names, but we are short on time, so I'm going to pick one of the
Go.
two. Dutch Bros.
Dutch Bros, love it. East to west, continuing to expand. Stock is under pressure. There's a gap in the chart. If the gap gets filled, we would be a buyer.
Okay, and look, it has actually done pretty well year to date.
Oh, absolutely.
Relatively speaking, so you see an opportunity here, and on a year-over-year basis, it's done really well.
100%.
So some people are happy.
I am happy with the position. I do think now that we're through the BlackRock Coffee IPO
Okay.
and at prices, I think we'll start to see things kind of return.
It's an opportunity to accumulate more,
Agreed.
basically. All right, thank you, Chris.
Sure thing.
Appreciate it. That's Chris Versace, Chief Investment Officer, Tematica Research.